the drivers that support economic growth and earnings are slowing down. And that's why, and now I'm gonna give you your headline for the week. You're always trying to dig up some bearish headline out of me, so I'm gonna give it to you. But that's why we're turning more tactically bearish this year on stocks, is because of what's see, he's already writing it down.
Love it
But
when you do my work for me.
and that doesn't mean markets are going to crash, but I am certainly much more concerned about where markets are trading in the short term because of kind of really coming back to the basis of it all, which is valuations.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week with my good and lupine friend, portfolio manager Lance Roberts. Lance, how you doing?
I don't have lupus. I don't know.
So lupine, it means wolf-like, and that adjective will make more sense as we get to today's rant. All right, Lance, lots going on this week.
Yep.
I kind of lost track trying to pull together topics for today's market recap for the week. But maybe we can just start real quickly with two things. One, I see you wearing a sweater, which is not normal for you, and that's because you guys are having a pretty big cold snap there in Texas, right? And lots of the other, eastern part of the country.
It is, and at my house, I refuse to run heat during the winter, so it's a little chilly in my house today. So that's just part of the concept. My kids are like, "Turn on the heat." I'm like, "Put on sweat clothes. You're wearing a hoodie all the time anyway." So
As older dads, that's just baked into our genetics, right? Don't touch the thermostat. Just put on a sweater. And sadly, you're having a very different experience than people living in the southern part of my state, Southern California. I do want to just start with a recognition of the horrific losses that are going on down there, property-wise, but also loss of life. It's really interesting, Lance. There's a lot of anger brewing here in California, and look, I've been through something very similar. We had our fires up here a few years ago for a number of years up here in Northern California. I'm sad to see my southern brethren getting it now. A lot of frustration as to the conditions that have led to this much destruction, right? There's fingers getting pointed, and many of them for very good reason. Whether it was poor fire management, whether it was defunding of resources that were supposed to go to either staffing the fire department or investing in better infrastructure. And, we're hearing all sorts of stories, and it's still fog of war going on right now, but, stories of the fire hydrant systems running out of water, equipment that had been there that's been shipped off to other parts of the world now. The mayor of LA was actually out of the country, when this hit, and people were wondering, well, how come you're not actually here,
right.
So what's kind of interesting about this is, California, run by Gavin Newsom, who is, being talked about as maybe the main contender to challenge the Republicans in the next presidential election. Early on, a lot of fingers being pointed his way. He'll probably end up making it through fine, the way that most politicians do, but maybe
Right.
not. And the reason why I'm mentioning this is I just did a quick search of changes in heads of state of major countries, and it just in the past year or less, and it's a long list, right? Here in the U.S., Biden is now leaving, Trump is coming in. Congress has now flipped Republican in both houses. We have Justin Trudeau, who just announced that he's going to be stepping down as prime minister. Highly likely that when they hold elections in Canada, it's going to be the Conservative Party that goes in. Mexico, has a new president. There are big threats going on right now to the ruling regimes in France and Germany. Italy, Meloni went in there not that long ago. South Korea, Taiwan, Singapore, Japan over the past year have all replaced their head of states. Argentina with Malay. UK, Keir Starmer is new there, and he's even under pressure this early on in his regime, and he might eventually get replaced. Iran has a new president. Syria, doesn't even have a government right now. The point is, there's a whole new set of players on the chessboard. I mean, really, with sort of the exception of Putin and Xi, it's all new players. And the reason why I mention this is there's a lot of things that I think people, a year or two ago thought, oh, that could never happen, or that's just not the way the winds are blowing. Winds of change are now blowing through the world globally.
Right.
And it may open the doors for lots of different things than we expected. And that may have some market implications down the road, and we can talk about that. But I just wanted to sort of note the fact that there is almost a complete changing of the guard going on right now.
No, there is. And I think it's really fascinating because just this past week, Mark Zuckerberg came out and said, hey, we're scrapping all the fact checking on Facebook and we're going to go to basically the community notes type version that X did and allow the community to, kind of focus on, kind of what information is valid, what's not, because, so we're seeing this change of dynamic across the entire world. And what you're seeing is really kind of a function of the fact that all these policies that were voted for, in a lot of cases, didn't work well. And people are not better off. People are, not seeing the benefit of what they were promised from these policies. And so now you're starting to see, well, now I want something different. So now we're starting to see people vote in a manner that says, these are the policies I want because those should give me a better outcome down the road. And these aren't, massively mind-blowing changes, but we're starting to see that really take a foothold across a lot of these countries. Germany's in a lot of trouble right now. France is doing terribly economically. UK's got a bunch of problems as well. And so now you're starting to really see that rise of people saying, look, I just want something different. I want something better for me and my family. And, we've talked about this before on the show, is at the end of the day, politically, you can have whatever view you want. That's irrelevant. But at the end of the day, what it really comes down to is, can I feed my family? Can I kind of raise my children and be safe? And can I have opportunity to and better my lifestyle? And as long as policies are being implemented that provide those basic foundations, you'll have a happy population and people will vote for you. But if you're not giving them that, if you're making them a lot of promises that don't get fulfilled and the safety of their families are at risk, their ability to sustain their lifestyles at risk, their children are at risk for one reason or another, they're going to vote for different policies. And I think we're seeing that now really kind of across the board.
Yeah, and here's why I bring that up, which is for two reasons. One, these changing of policies, especially how countries run themselves, will have economic implications, right?
Yeah.
So, and we are seeing a shift now from globalization, which has really been the trend, since the 90s or so, now starting to shift to a more nationalistic, or as Michael Every would say, a more mercantilistic global dynamic. And in Michael's, perspective with his long arc of history, mercantilism has really been the name of the game, and globalism was sort of the aberration. But that era may be, ending/reversing right now. And of course, that can then lead to lots of different economic changes like tariffs and things like that, right? But I think the main reason why I bring it up here is, look, I'm not trying to get in a debate of right versus wrong. I don't disagree what you said, Lance, for the reasons for this, and I'm not trying to take necessarily a political point of view here. But we talk about in the markets that with a lot of debate over, okay, are we going to keep going in a bull market, or are we going to start a bear market? Is there going to be a correction, right? And at the end of the day, what has to shift for change is sentiment.
That's right.
And that's what I think is going on right now, is we're seeing a shift in voter sentiment and in leadership sentiment. And what I think is notable about it is the pace of the change. So there's a saying, I think it initially was attributed to maybe Niels Bohr, and he meant it about science, but it's true in many things, where he said, progress advances one funeral at a time, right? You got to wait for the old guard and their old ideas to die out before new ideas come in. Well, we're kind of seeing like a mass extinction event, if you will, of the old guard politically. So
Right.
this adoption of new sentiment is happening at a faster pace than it normally does. And so I just want to note that, because as we go into a new year, a lot of the people I've been interviewing, maybe even I think you to a certain extent, I think rightly so, have been saying, hey, I think 2025 is going to be more volatile than the past recent years we've been used to. And I think this sweeping change in leadership around the world is just accelerating that.
Yeah, and look, don't get me wrong about what I was saying earlier. I'm not making a political conviction one way or the other. I'm just saying that, I can, I can make an investment decision that I think is the best possible investment decision for my clients, and it turns out to be wrong. That happens. Same thing with political ideology, right? I can say, well, California is a great example right now. They've made decisions, economically, to not clear brush away from houses, and not institute fire breaks in a lot of cases, and not store a lot of fresh water in other areas because of some ecological issue, right? There's some red-legged frog that we need to save, that live really close to houses, and so we can't clear the brush away. Well, the consequence of that obviously is that you've got a lot of tinder right up next to a house, and that becomes problematic when you do have a fire. So fire management's a very important thing, but we can make decisions that we think are the best policy decisions at the time, and there's nothing wrong with that. The outcome of it is what will determine the value of that decision and the consequences that they do that. So again, policies that were made under, the Biden administration, they were done with the best of intentions. Policies that were made under the Trump administration previously, done with the best of intentions. Everybody institutes policies based on what they think is going to be the best for the population. It's only in hindsight that we can tell whether or not those were successful or not. And if they weren't successful, people are going to say, I want to change, and they're going to vote for something different, regardless of whether that next policy coming up is good or bad for them, right? They're just going to vote for change because the last ideas weren't good for them, and that's what we now know after 4 years.
Right. No, I agree with everything you're saying. Although, I agree with most of what you're saying. I think some people listening, I'm probably one of them, are like, best of intentions. Maybe not every case. Maybe it's best for what the politician wanted to get done for their agenda, right?
Best of their intentions, right? Best of intentions for anybody, but I mean, you pass policies that you think are going to be best for whatever reason, and that's my whole point, is that we can all make decisions, and only in hindsight do we know if that decision was good or not.
Right. And I guess just putting a bow on the California part, then we'll get to the markets, is, there's so much so many dominoes that have already fallen, where before the domino fell politically, people wouldn't have been able to imagine that domino toppling. And the big example that I've used before is, right before Biden got on stage with Trump and that disastrous debate, I think most Democrats couldn't have imagined that, within a month, he'd basically have been forced to step down and hand over the leadership of the party, or his future candidacy, to a different person. California has been run a certain way for a long time. People just sort of begin to think, well, California will always be this way. I know it's going to be interesting. There's going to be some, I think, pretty big pressures for some pretty big changes coming and following this, and we'll see what happens. But most importantly, if you're watching this and you are in Southern California, I certainly hope you've gotten to safety. I certainly hope that your property is avoiding the fate of thousands of people down there so far. But hopefully this gets over quickly. All right, so maybe additional I don't want to say surprises, but maybe to some people. Before this morning, and we'll talk about this morning's news in a second, one of the members of the Fed, Bowman, said that the December rate cut was, quote, the last step in policy recalibration, which people have basically taken it as, hey, the Fed's going to be done cutting for a while, right? Then we got this morning's payrolls report, which was like a 4 sigma beat. Really surprised everybody to the upside. Everybody but, and I got to give her complete kudos for this, Anna Wong from Bloomberg Economics, who's been on this channel frequently or regularly. She has been crushing it in terms of her predictions for the unemployment rate and for the payroll numbers over the past year. Whatever she and her team, are drinking there at Bloomberg Economics, it's been working well for them. So she was the only person who predicted that the payrolls number could be as strong as it is today, and the unemployment rate actually dropped from 4.2 to 4.1%. So I think for the markets, this was, a massive, big wooden stake driven into the heart of rate cuts. And the market, I think, has basically said, pardon me?
Read a whole bunch into that. First of all,
maybe you wouldn't, but it seems today that that's what people are taking from it.
Yeah. Certainly. The markets certainly are, because they basically react to whatever piece of the news of the day there is. And then traders basically are going to go long or short whatever asset class they're, going long or short on. But if you actually dig down into the employment report data, look, there's no doubt the employment number was very strong, but full-time employment relative to the population continues to decline. We're now down to 49.5. So, we're seeing increases in temporary help, but even the temporary help rate has been dropping. So despite the fact that the employment number was strong, the underlying trend of weakness continues. And,
and sorry to interrupt, but despite payrolls being as big to the upside, hours worked actually went down. Average hours worked went down, right?
and so again, the knee-jerk reaction to that is, and again, what's interesting is, right, is that the markets aren't reacting to the news, right? So if I have a really strong employment report like I have today, that's actually good for the economy, right? That's good for earnings. That's good for the economy. It means the economy is doing fine, which means earnings will do fine because earnings come from economic activity. So stocks should be up 1.5% or 2% today on that news, not down 1.5%. So the markets are only reacting to what they think the Fed's going to do next. So and this is how addicted we've become over the last decade now to monetary policy. It's like, oh my gosh, I was counting on rate cuts and the Fed doing QE to boost asset prices further. But what if they don't cut rates anymore? Well, first of all, the Fed's wrong, like all the time, right? Whatever the Fed thinks is going to happen, typically, you go back and look at their prediction record, it's terrible.
Oh, it's terrible. It's terrible. Yeah. And by the way, I would say this is the past 25 years, not just the past 10 years in terms of market trying to figure out what the Fed's going to do. But keep going.
But even so, since the financial crisis, even more so, it has really been focused on just whatever monetary policy is. When's the Fed going to cut rates back to zero? That's all I need to buy stocks. And so we've gotten addicted to all of that monetary policy, but we're not trading against actual economic activity, which is slowing down. The drivers that support economic growth and earnings are slowing down. And that's why, and now I'm gonna give you your headline for the week. You're always trying to dig up some bearish headline out of me, so I'm gonna give it to you. But that's why we're turning more tactically bearish this year on stocks, is because of what's see, he's already writing it down.
Noting the timestamp. Yep.
Yeah.
But I love it when you do my work for me.
Yeah. So, but yeah, I mean, and that doesn't mean markets are going to crash, but I am certainly much more concerned about where markets are trading in the short term because of, kind of really coming back to the basis of it all, which is valuations.
Right. Which we'll talk more about this, I'm sure. They're terrible trading indicators in the near term, but in the long term, they're very accurate, right? So part of this, I want to pull on that thread with you at some point to say, okay, so why now are you getting worried about valuations versus?
Well, no, I'm not worried about valuations. Valuations have been elevated, but in order to support valuations at these levels, you've got to have really strong economic growth. Because again, where do earnings come from? Comes from economic activity. It just doesn't magically appear. So if you have rising interest rates, if you have sticky inflation, those type of things, and that's your bet, then valuations become much more problematic at these levels. And that's why if we are in a period where things are going to stabilize at potentially a higher level, that's not going to be supportive of valuations at 35, 36 times earnings.
Right. So you're worried about valuation. You're more worried about valuations now because you're more worried about your future expectations for where earnings are going to go.
Yeah. Exactly. And at the end of the day, everything put aside, it's all about earnings.
Yeah.
Are they going up or are they going down? That's the question.
Okay. All right. Well, lots to dig into. I guess before we move on, anything else to say about the jobs numbers? I mean, I guess first and foremost, do you agree? Is this going to increase the likelihood that is it going to make it harder for the Fed to cut from here?
Yeah, sure. No, absolutely. The Fed's, if the Fed's, of course, now look, the employment numbers are one thing, but we've got CPI and PPI next week, right? So if expectations are right now, so we're going to have an uptick and the CPI read 0.3% versus the 0.2% expectation. So if inflation comes in hotter than expected, that's just going to make sure that the Fed does not cut rates, at the next meeting. So, again, but no, this employment number absolutely is going to slow down the pace of rate cuts for this year. until the economic data shows up. And unfortunately, where the market errors most times is that the market never anticipates how much the Fed is going to go either in one direction or the other. So if the market's expecting only 2 rate cuts, you're likely going to get 4, because at some point, something's going to happen. All of a sudden, the Fed is generally behind the curve, and they'll say, okay, great, we're not going to cut rates this time because we think inflation's doing X or Y, and then in the next couple of months, something hits the fan, so to speak, and all of a sudden you've got a sharp drop in economic activity, and now they're having to play catch up trying to cut rates. So, again, that's just the way it normally happens, and we'll see what comes here. But no, with the data today, and if CPI, PPI come out pretty much either in line with expectations or slightly hotter than expectations next week, then absolutely the Fed's not going to cut rates at the next meeting.
Okay. And I'm asking you to speculate here. Let's say that happens, right? How long do you think the Fed's on pause for?
Until something breaks.
So something breaks. Okay. All right. So
it's going to break.
So let's go there. So one of the things that's jumping again this morning on this news is the 10-year yield, right? So we have we're going to be in higher for longer yields than the market was expecting at the start of this year, right? Or start of the Fed's cutting cycle, if you will. Right, market couldn't wait for the Fed to pivot. Right, I mean, let's go back in time 5 years. Right, market had just been salivating every month. Okay, the Fed's going to cut, Fed's going to pivot. Powell announces the 50 basis point start in September. The market's just super excited. Animal spirits go wild. Fed keeps cutting, but longer term yields keep creeping up. Right, so now I think the market's beginning to realize, oh God, like, these yields aren't going to come down anytime soon, and if the Fed's done cutting, they're probably going to stay even higher for longer, right? So A, would like to get your thoughts on what the implications of that might be. B, let me just tell you, so I interviewed Bill Fleckenstein the other day, and his forecast, which actually now sounds pretty similar to what you just said, is I said, hey, Bill, what's your forecast for the year? And he said, my forecast is, he gave me my headline too, which was really nice of him. He said, bonds leak until stocks tank. He said, he thinks that bonds are going to keep trending down in price, yields are going to keep trending higher until there's some event where the market just capitulates and we get some downdraft, highly likely to probably, depending on its severity, but the more the severity is, the higher the likelihood is that the Fed then steps in and really starts, cutting rates like crazy, or maybe even thinks about stopping QT and starts doing some other stuff.
Right.
Thoughts?
No, absolutely right. It's interesting, rates right now. So, a couple of things about rates, where they are. And we've got an article out on our website talking about where rates should be relative to actual economic growth and inflation that Mike wrote on Wednesday. So he's actually got, kind of a graph put together with the Cleveland Fed inflation index, which is, got some long history to it, as well as GDP. And when you look at that index says that yields are about 1.5 points too high from where they should be relative to where inflation is. And if you think about it, interest rates on the 10-year are creeping up towards about 4.7%. Well, last time they were here, inflation was almost 9%. So we're at 2.7, 2.8% on inflation now, but you've got interest rates in the economy at thinking that inflation's running near 9%, and which is not the case. So also what happens is the last time we had interest rates here, you had the Silicon Valley Bank crisis, right? So when interest rates go up, it impairs the bank collateral. It makes borrowing more expensive. And, if you take a look at what's happening now with the consumer, you had a very big drop in consumer credit just in the last report. And at the same time that you've had that big drop in consumer credit, which is basically how people fund their standard of living these days, you've had a very sharp rise in the number of people not being able to get credit from the bank. In other words, banks are tightening up credit lending standards, so people applying for credit are getting rejected at some of the highest rates we've seen in quite a few years. So people aren't being able to get access to credit. At the same time, their lifestyles being impeded by slower economic activity, slower wage growth, and they're having a tougher time meeting that, which is all going to feed into economic activity. And economic activity slows down. Again, we go back to the very basic premise of all this, which is stock prices are all derived from earnings, which comes from the economy. But if interest rates move too much further from here, you run the risk of triggering another collateral crisis with banks. The Federal Reserve's been reversing repo. We've got the potential for a liquidity crisis in kind of the markets. And just this past week, we talked about equity funding, which is now at a point risk where typically it impacts equity. So there's a whole lot of reasons why we're becoming a lot more cautious about our outlook this year. Now, nothing's broken down with the markets right now. So far, everything's kind of holding exactly where they should be. But if we start to break, and I've got to, when we get into kind of our chart review, we'll talk about some of the risk. But there's a rising risk now that we're going to see the markets begin to be impacted by kind of what's going on with higher rates. And kind of another good example of all this is that, we've talked about credit spreads in the past. And right now, if you take a look at the Treasury bond to credit to the junk bond spread, that's at some of the lowest levels on record. But you've got a very big surge in corporate bankruptcies that are not being reflected yet into high yield corporate bond prices. So again,
I was going to mention that, yeah.
Right. So my point is that there's just a tremendous amount of evidence that consumer sentiment, or investor sentiment, I should say, is extremely bullish. But the underpinnings that support the market are being deteriorated. It's kind of like water washing up on a beach and slowly eroding the coastline, right? It's these little slow endeavors that occur, and then all of a sudden we wake up one morning and half your beach falls off into the ocean because there's no support for it anymore. That's kind of where the market. And again, let me be very clear. I'm not talking about how the market, you're not going to wake up tomorrow. And I think this is an important point we need to cover on the show today is about how corrections happen. You're not going to wake up tomorrow and the market's going to be down 50%. I'm not saying that. But, we could have a year where the market begins to erode and we have a 10 or a 15 or a 20% correction over a period of several months that eventually kind of works itself out. We have a rally into year end, but I think there's a rising possibility. We see, again, as we said before, a rather significant pickup in volatility this year. And this year's market is going to be a lot more difficult to navigate than what we saw last year.
Okay. And, pat ourselves on the back. We were saying coming into 2025, probably going to be a disappointing year versus the previous 2 years. Seems like your conviction of that is just going up. So let me ask you this. So talking to Bill Fleckenstein, he said, when I was asking about the stock market, he said, look, the stock market is just, it doesn't give you good signals anymore. And the reason why is this passive capital inflows, right? Mm-hmm. The giant mindless robot, right? It's not a good signaling mechanism anymore. So like Bill's, part of his fame was built on being a great short seller. And he's like, I'm not being aggressively short right now because the market, it's not giving me what I consider to be a true signal. And so I can't make really good decisions based off it. I just know it's heavily distorted by these, capital inflows that come in every month that have to buy, right? And then he mentioned a whole bunch of risks, some of which you just mentioned there. But basically just kind of saying like, I don't trust the signal the market's sending me, right? I think it's a false one. Right. So one of the signals that many people, you included, have said is, hey, the key thing you got to look for is when the bond market gets worried, and the indicator that tells you that are credit spreads, right? But folks are looking at credit spreads and they're just like, I don't know why these things are so goddamn tight, right? There's all these other issues in the bond market, rising yields, whatever, right? That make us worried, right? But these stupid credit spreads are still really tight. So my question to you is, are credit spreads still a quality signal, or are they impaired for some reason?
No, they're not impaired. The difference with credit spreads. So Bill's right. And, you and I have talked about the whole issue of ETFs. And this is a good example. Last year, we had about $1 trillion worth of money flow into ETFs. And that's why you saw the Mag 7 outperform everything else again last year, is because they make up basically about 39, the top 10 stocks in the S&P make up 39% a little bit more than actually approaching 40 now. But
Yeah, the top seven, the Mag 7 make up 36%. I only know that because we're going to talk about that in a minute. Yeah.
so, but the top 10 make up 39%,
Yeah.
approaching 40. So every time somebody injects $1 into the S&P index, and all of the variations of these market cap weighted index, the market just gets, those stocks get force fed 40 cents of every dollar. And it was interesting because I posted just recently on Twitter, I posted a comment about this concentration of passive indexes, and a guy that's promoting his ETF service is like, yeah, but you could have bought this other ETF that's a value ETF and you can avoid the market capitalization issue. And I'm like, yeah, you're absolutely right, but you massively underperformed the market cap weighted stocks because that's what performance is. And if you strip out the earnings generation, so again, we said earlier, right, all that really matters at the end of the day is earnings. And there's plenty of evidence that supports that. The direction of earnings determines the direction of the market. So if you strip out the earnings of the top 7 stocks, the S&P had basically no earnings growth. I think its earnings growth last year was about 1%. So if you strip out if you get into the small cap stocks, they had negative earnings last year.
Right.
So, we have a very problematic market from the standpoint that, just from an earnings standpoint, you just have these massive companies, Microsoft, Google, Amazon, Meta, just printing cash because they have just now dominated the entire capitalistic marketplace, so to speak. I mean, it's just, the money that Lockheed Martin makes is a drop in the bucket relative to what Meta produces in terms of revenue and income, because we've just all become this digital society, and right, it's just everything's about advertising and promotion, and because we're a consumer economy, and you're not.
And these things, they're ferociously profitable too. They don't.
Right.
They don't. Yeah.
Yeah, their cost of their price. So think about that, right? What if I'm Meta? What does it cost me to produce an ad for the website that I'm collecting revenue on? So you want to go place an ad to me, you produce the ad, you give it to me, I post it on my website, and you pay me money to have it on the website. That my cost structure is extremely low compared to, say, a Lockheed Martin or a Raytheon, who's going to spend hundreds of thousands of dollars to build a Tomahawk missile that they sell for $1 million, right? So, just the cost structure of Google and Meta in particular, and even Amazon to a large degree, is just extremely low. And they have that, and again, now the move into digital, data centers and all that. Once I have the cost of the data center built out, my cost structure gets super cheap after that. So, and look, that's not going to change anytime soon. And this is one of my big arguments for this year, which is all the analysts are going, yes, the growth rate of earnings for the Mag 7 are going to slow down, but don't worry, because small cap stocks are going to explode. They're going to have a 44% growth in earnings. Why? Where if they weren't able, we had the strongest economy literally going back on record over the last 3 years because of all the money we injected into the economy, and small cap companies couldn't earn money then. What's going to drive their earnings next year? Right? There's no basis in that argument. It's more of just, I'm just kind of hoping it's going to happen. But, I think the big risk, again, this year, and another reason that, we're much more cautious in our outlook, is earnings growth, I think, is going to become a lot more challenged.
Okay. So obviously that's one of the reasons why you are increasingly concerned about where things are headed in 2025.
Let me state, real quick, I'm not saying the market's going to crash. So just, just
I think you've said that enough. I think folks get it. But yes, so we'll just underscore, Lance, not calling for a market crash, but can definitely see a correction this year, one that might take place over months or quarters, whatever. But just you just see an uncomfortably high probability of downside risks that you are potentially changing your investment strategy versus last year.
Yeah, correct. And again, just real quick, if you want to take a look at, we promised everybody that we keep an update on credit spreads.
Pull them up.
We can just take a look at a couple of charts here on yield spreads.
Okay. Go ahead. While you're pulling it up, I'm going to just mention a chart I don't have here, but I've seen recently, which is the earnings yield on the S&P is usually higher than bond yields, than corporate bond yields,
Correct.
right? Because equities, they're riskier, and therefore you invest in them because you're going to make more money on average than safer bonds. But that's now negative.
Yeah.
So you actually are getting paid less to take on more risk now in the equity market.
Which is one of the reasons why, where interest rates are now, it becomes a lot more advantageous in the future. And this is going to be one of the issues that we'll have to deal with at some point. But at some point, investors say, I can get a 5% yield on a 10-year treasury and a 0% earnings yield on stocks. Why would I own the risk in stocks?
Mm-hmm.
Right. And that becomes, and I'm actually looking for that chart. Give me 1 second. Oh, right here. So let me stop that share and change share here real quick. So this is the chart I think that you were looking for. This is the equity risk premium of stocks versus the 10-year treasury. And normally, as you correctly stated, the equity risk premium should trade above the 10-year treasury yield. And
Right. And just for folks, usually the gray line trades above the light blue line.
right. Yeah, normally it should. You should have a higher yield in theory. And again, this is theory and doesn't mean it's absolutely going to happen. But you're simply not getting paid to take the risk on equities. And again, doesn't mean you shouldn't own equities. Right? That's not what that's saying. It's just saying that you're not really being compensated for the level of risk that you're taking. And again, this kind of goes back to the importance of credit spreads. So this is the AAA. This is Moody's AAA rated versus BAA rated bonds. So BAA. So this is the entire, and what we call it. So real quick, let me step back. If you don't understand the bond market at all, which is evident from most of the questions I get from people about bonds, investment grade bonds are what pension funds, mutual funds, hedge funds, et cetera, generally invest in. Unless you're running a high yield fund, then you buy lower quality credits. But in general, if you're running any type of pension money in particular, you buy what's called investment grade. Investment grade bonds are anything from using Moody's ratings, BAA to AAA. And that just simply says that these bonds typically are going to pay out at maturity. And if you look at S&P ratings as an example, they use BBB to AAA. So same set of ratings. That spread right now between BBB bonds and AAA rated bonds are basically at the lowest level we've seen ever. And typically, and I've highlighted this with the vertical lines, you'll notice that when yields are this low, you typically get an equity market correction or consolidation at some point. It doesn't mean the market's correct all the time, but you may go through a fairly long period of several months to a year where the market just does nothing. And it kind of works through that process. But what you need to know that, what's important is that when that spread starts to increase, that's kind of your warning sign. And right now, we don't see any increase in that spread. Another version of this is kind of what I showed you previously. This is the treasury bond. So this is AAA to junk bonds. This is, in my book, this is the golden measure. Because this has the best, kind of the best predictive track record of predicting market corrections. And when this spread starts to increase, and we saw a very small uptick last week, and there's nothing to read into it right now, it's just a very small uptick. But if this yield spread between high yield bonds or junk bonds and treasury bonds starts to increase fairly significantly, that's been a good precursor to get much more cautious about your equity risk in your portfolio.
Okay. Let me just ask my question one last time.
Sure.
Why is it so tight right now, given the concerns that kind of anybody with half an eye open can name?
Well, you're looking at, the problem is you're looking at it from the equity market, right? You're looking at it from the stock market view. The bond market right now, there's not a lot of pressure on bonds. Most corporate equities or most corporate companies that have bonds issued, there's not any funding risk. to these companies. They're able to pay their debt. There's not a lot of defaults on the debt right now. We've seen bankruptcies go up, but again, we haven't seen a tremendous increase in the number of defaults on bonds, and that's what's going to drive this. So again, at the end of the day, the big difference between the bond market and the stock market, and I'm sorry, this is where I was trying to get to earlier and I got sidetracked, is that the bond market is a function of fundamentals. If I'm issuing debt to somebody, I'm going, okay, I'm gonna loan you money. My interest rate has to cover inflation, opportunity costs, credit risk, all these risks. Because once I issue that debt, I can't change the coupon. I'm stuck with the coupon for the term of the debt. So my coupon has to cover all the risk over the duration of that bond. So if I'm issuing a 10-year treasury, as an example, my coupon rate has to cover all the potential risk. Now, in the short term, prices can move up and down, right? That's just simply market dynamics. So it's just, we've got a lot of hedge funds right now shorting the 10-year treasury as an example because inflation's going up. So if they're shorting it, that drives prices up and that drives prices down and bond yields up, and which makes that trade profitable. So they pile more into it, which drives bond prices down, yields up. But that has nothing to do with the fundamentals. The fundamentals ultimately rule where inflation and interest rates are going to go, and those fundamental dynamics do not support interest rates at this level, and that's what I was talking about earlier. So again, you get these short-term dynamics that move rates around, but the impact of higher rates on economic activity is where it's going to drive markets longer term. But again, that's why there's no, the credit spread market is not reflecting risk right now because it hasn't shown up in the credit market yet.
Yes. Okay. But so let me just ask my question a different way. And I get that I'm missing something here because credit rates are what they are, right? If I'm having trouble understanding it, I know the bond market doesn't care about Adam Taggart's, mental challenges.
Yeah.
But, they say often that the bond market is the smart money, right? And the bond market is math. Right? That's one of the reasons why people love it, right? Is it's just really math, right? But that math should be reflective of what the bond market sees coming down the road, right? I don't believe, and you correct me if this is a wrong assumption, the bond market doesn't wait for defaults to start rising to say, oh, well, then we should probably start adjusting pricing. The bond market's got a bunch of really smart people in it. They're looking at probability of defaults rising in the future, and they will price that in as soon as their models tell them it's coming. You're nodding as I'm saying all this, right?
Yes.
Okay, so
you're
I'm not crazy.
You're absolutely right.
All right, so good to know I'm not crazy. So let me just mention a few of the things you mentioned.
Yeah.
Inflation expectations. Okay. Well, now, folks have to realize that, inflation is going to be a little stickier than we thought, right? So there should be adjustments for that. Credit risk. Well, we've got the corporate debt maturity wall that's going in earnest in 2025, where a lot of companies, not every company, but a lot of companies will be re-rating to higher debt service costs, right? That's going to be affecting things. We've got the BTFP that in theory should be shut down in just a couple of months here. That theoretically will have some implications unless the Fed announces, hey, we're going to extend it again. We've got the new administration coming in with different policies and potentially tariffs and stuff like that. And there's going to be some winners and losers out of that. Like there's just more uncertainty coming in. And I would think, given all that the bond market should be maybe having to just price in some more uncertainty, right? But right now it seems that these spreads are about the tight as they've ever been. So why is it not worried at all here? That's what I don't get.
Because fundamentally, again, everything you just mentioned is all sentiment, right? And this is a very important point about.
Okay, but let me just mention this so you can answer it. It's not just sentiment. It's possibility, which should be in an expected value. There should be some percentage given to that.
No. See, that's all sentiment. See, it's all the stuff you think is going to happen, right? And look, this is crucial to kind of what we were just talking about this week. So again, I talked to Michael Leibowitz wrote this article talking about why bond yields are rising. And so if you take a look at the fundamental bond components of this model, right? It's the 10-year yield versus real GDP and the Cleveland Fed Inflation Index. Now, the Cleveland Fed inflation is all about sentiment, right? It's what do people think? So take a look at just, the consumer sentiment data that came out today. inflation expectations went up because 87% of the people that were surveyed were worried about tariffs. They're worried about tariffs, right? Now, there's no evidence historically. We've done the research on this, and we produced that article a couple of weeks ago about this. There's no, going even back to 1915, when 85% of all the revenue of the government came from excise taxes and tariffs, did not create inflation. So people are worried about tariffs because the media tells them that, oh, if there's a tariff, then all your prices are going to go up. Well, there's not really any evidence that occurs. We saw it back in 2017, 2018, 2019. We had tariffs, prices didn't go up. We didn't have inflation. So sentiment is about expectations. And so when people are worried about something, I'm worried about higher prices, that drives inflation expectations up. And that's that kind of that black, kind of that gray dotted line of background. And we've definitely seen that Cleveland Fed inflation index creeping up over these worries or concerns about the markets. And so you combine that with GDP, because where does inflation come from? Inflation comes from economic activity. Inflation does not just basic economics. Inflation is all about supply and demand, period, end of story, no argument, no debate. It doesn't come from any other thing. Deficits, debt do not create inflation. Inflation only comes from economic activity. So if GDP is slowing down, the reason we had a big spike in GDP growth was because we injected the economy with a massive amount of stimulus. That's all coming out of the system. And so as that continues to slow, you combine the inflation expectations index with GDP, that's going to slow down. Interest rates, and so this is where you get into the actual model that Mike built, is this. If you take the Cleveland Inflation Index and GDP, it has about a 96% correlation over time. And this goes back to 1990. So but you'll notice that whenever the 10-year Treasury yield got above the inflation GDP model, and interest rates corrected back to the model, not the other way around. The model didn't correct interest rates. So again, right now, when he did this chart, the 10-year Treasury was at 4.57. It's now about 4.71 this morning. So the model says that interest rates should be at 3.78. So again, you've got this massive spread between interest rates and what happens in the real economy. So again, to your point, everything you're talking about is inflation expectations. I should have inflation because of all this other stuff. The reality of what occurs all comes from economic activity. So if I'm concerned, so question back to you, Adam, if I'm concerned about interest rates going up, do I postpone purchases? Or, and here's what's happening right now in real time, and we're seeing this real time right now. If I'm worried about tariffs, and we saw this in the ISM indexes, we saw this in the S&P global PMI indexes. If I'm worried about tariffs, what do I do as a manufacturer? I go buy a bunch of product and inventory right now because I want to get ahead of the tariff. So if I buy a lot of goods from China, I go load up on inventory right now. Well, if I do that, what happens to the prices of goods and services that I'm pre-buying at the moment? They all go up, creates inflation short term, creates a big jump in retail sales. So, and that's what we're seeing. We're seeing that in the data right now as people trying to front run that impact of tariffs. Well, when the tariffs come, I've already bought all my inventory. What happens in the next 6 months, right? Because what happens to the demand for goods and services 6 months from now if I've already bought everything I need for the next year?
You pulled it forward, so the future demand's lower. Yeah, got it. So
Right?
let me just interject though, because I think you're making the point here why bond yields should come down, right?
Well,
The
the point I'm making is, and this feeds into the fact of why we're more bearish, more tactically bearish this year, is that all this suggests that we're about to see a fairly significant contraction in economic growth later this year.
Okay, and I'm not disagreeing with any of that. And here, let me pull one thread here to see if you can help me see clearly. So let's say folks are concerned about rising interest rates or cost of debt, right? Oh, it's going to be higher for longer now, right? I would think in my models, I would say, okay, well, that's going to hurt, uh, the zombie companies a lot more than it's going to hurt the Apples and Magnificent Sevens of the world, right? And so I might go change my model if I think, oh, they're going to, interest rates are going to be higher for longer. And I think that high yield companies are going to be more pressured as a result of that. Companies that issue high yield debt are going to be more pressured than that. So I'm going to want a little bit more yield on high yield debt than regular investment grade corporate debt. And I would expect credit spreads to start widening, but we're not seeing that yet.
Right. Okay. Well, hold up. You're missing the math problem. Okay. So let's do some real basic numbers. Okay. Because you're looking at two things independently, but you have to look at them together. So let's just say that my credit spread is the difference between two yields. Okay. Right. We agree with that? So let's say that the 10-year treasury rate is 2% and the my high yield corporate bond is 2%, right? So they're both yielding exactly the same thing. So my credit spread is 0, right? So now interest rates have moved up to 3% because I'm worried about inflation and tariffs, et cetera. And at the same time, investors, or, people loaning money to high yield companies go, yeah, I'm a little worried about you next year. So now I'm going to charge you 3. So now we're both at 3. What's my credit spread?
It's still 0. I get it.
0, right? So that's why the credit spread isn't moving yet. So what happens though is at some point, the economy slows down. You have some break in the economy, something happens, all of a sudden 10-year treasury yields drop. And now you've got a spread between a 1% treasury yield and a 4% corporate high yield, right? Now all of a sudden you see a big jump in that credit spread when those start to reverse.
Okay, so back to my original question. There are all these things that we could say, we could make the argument the risk of a number of these things is higher than it was 6 months ago or 3 months ago, or whatever, right? And I would just think, okay, so you'd start discounting the prospects of the worst debt issuers first, and you should start to see some sort of spread there because interest rates are going to be higher for longer. Inflation looks like it's going to be stickier for longer, or the BFTP is going to get undone, or this whole list of things, right? But we're not seeing any daylight yet between the junky debt and the good debt, and I just don't understand why.
Well, it hasn't come to fruition yet because again, we're seeing 10-year treasury yields are not reflecting the actual economy. The actual economy is growing at about 2.7%. Mm-hmm. Your 10-year treasury is trading at 4.7. It should be trading closer to 2.7 to 3. They should be trading close to economic growth. Inflation is 2.7, 2.8. 10-year treasury should be closer to 2.7, 2.8 because yields track economic growth and inflation over time. So again, you got this abnormal increase in treasury prices right now over sentiment, which is sentiment's driving it. That's all that's driving it. It's not the fundamentals. And you haven't seen a relative pickup in concern in the high yield bond market yet, but that's coming, right?
Okay. I still understand why it's taken so long, but I will leave it there for now. And folks, I'm sure we'll revisit this in future episodes going forward. And I'm sorry if we spent a fair amount of time on this, but I'm guessing a lot of people have the same frustration I do. And we're going to be watching these credit spreads closely going forward.
Right. Here, look, this is a chart of just junk bond yields, right? So this is a chart of the B of A, double B U.S. high yield index. This is January of 2022. Yields have risen for high yield bonds, right? They've gone up, and right.
But that's because the Fed started hiking, the policy rate.
Yeah.
Then.
Yeah. What I'm saying though is that yields have risen. In fact, the last time we saw a big jump in yields was back when we actually shut down the economy, right? Everybody thought everybody was going to go to bankrupt at that point. But so they've risen from about 3.5% to currently running 6.2. So, there's been so this is my point, Adam, is that the yields have increased on high yield bonds, but they've also increased on treasuries, which is keeping those spreads very low.
Yeah, I totally get that. I just don't understand why over the past year, the yield on, say, I don't know if Google has any debt, but, Apple or Google or somebody with a mountain of cash, right? Why there isn't a growing spread between that debt rate and some junky zombie company.
Right. Well, again, a lot of this is got to do with the fact that investors are not buying fundamentals. They're just chasing prices. And
So that euphoria we're seeing in the stock market to a certain extent is also in the bond market too?
absolutely. What is, look, why do people buy Bitcoin? Right? Bitcoin is basically a leverage bet against the S&P. It's basically got a very high correlation. It's the same thing with high yield junk bonds. I can buy, for example, if I think the stock market's going up, I can buy HYG, which is the ETF for junk bonds,
Yep.
and pick up a 3 or 4%, whatever. I'm not sure what the yield is paying today, but just say it's 4%. I pick up a 4% yield on HYG, plus it will move in price fairly correlated to the S&P. So I not only get S&P market performance, but also pick up a higher yield. So it's a
You
way,
get paid for it, yeah.
it's just a way to basically kind of arbitrage a bit the S&P using bonds. And so we've seen a lot of that, particularly in bond funds trying to generate better performance. They've really overloaded a lot of their corporate bond portfolios into lower quality credit bonds to pick up higher yields and still getting price performance at the same time.
Okay. So I think it's fair to say that you think that a decent portion of the bond market is overvalued at the moment, and I'm talking more about the worst half of the bond market. Whereas credit spreads start to move, we would expect that it's going to be the junkier companies that those yields are going to rise higher faster, and that's obviously going to bring down the prices of that debt.
Right. And all this comes back to valuations, right? So again, at the end of the day, it's all about earnings. And as I said earlier, we've had this big chase in stock prices over the course of the last year, which are really 2 years. We've had the largest 2-year return in stocks of any 2-year period on average, like in history. So it's just, we've had this enormous move in stock prices, which has driven valuations up. But interest rates tend to be problematic when it comes to valuations. And so what this chart shows you is CAPE valuations versus interest rates. And whenever you've had a big increase in interest rates, you typically wind up having some type of problem in the stock market. Again, another reason we're kind of...
You should, right? Rising interest rates is like increasing the gravitational force on the economy, right? It's just going to be pulling it down harder as those rates go up, right?
And notably, when eventually you get the valuation correction, interest rates fall, rather dramatically, which is what you would expect because you have a risk-off rotation stocks into treasuries. So, again, it's just, we're at that kind of level that is beginning to really kind of, provide impairment to the ability of the market to continue to increase what people are willing to pay for valuation.
Okay. All right. So let's talk about valuations again. And let me preface this by mentioning this. Pardon my language, folks. But Fartcoin is now up over 500% from when it came out in October, beating Bitcoin's performance, leaving it in the dust, as this article says. Its market valuation is now approximately 1.5 billion. And I don't really know what Fartcoin is, but I think it pretty much, I mean, it doesn't purport to do anything useful. It just, you literally, I don't know, it makes fart noises or something like that. I mean, there's literally no, it's not going to be a currency. It's not going to be a store of value. It's not a claim on earnings in any shape or form, as far as I know. But its market valuation is now approximately $1.5 billion. That's more than around 1,000 companies in the Russell 3000. It's worth more than a third of the Russell 3000 companies.
This is the whole problem. This is the problem with the whole market in general, which is that we've just turned it to a giant casino. So people are willing to buy anything that goes up in price. Eventually this turns out really bad. We saw this same thing back in 2020 when people were buying, 2020.
Right, SPACs. Yeah, exactly. It's the irresponsible buying. It's going up. I'm getting on it. So let me ask this thing, because I didn't want to make the conversation about Fartcoin. My bigger thesis here, or question, and I just put this out on X the other day, where it seems that painting with a broad brush here, but everyone is in the same trade, in the same very narrow trade. So let me just give you a couple of statistics. So the US now has a record percentage of global market cap, right?
Correct.
So more of the capital around the world is crammed into the US than it ever has, in US equities than it ever has been. Um, uh, there's record record household exposure to corporate equities as a percent of financial assets. So consumers have never been more into stocks on a relative basis than they are right now. Pensions have record stock exposure right now. I couldn't easily find a number for corporate America either, in Wall Street, but in general, these stats are all saying that everybody is the most into stocks that they've ever been. Included with those households, baby boomers are way too exposed to stocks. 52% of them have invested 70% or more of their savings in stocks right now, right? So everybody is in stocks. Everybody is in US stocks, right? And then of the US stock market, as we talked about earlier, has the greatest concentration of market cap in the smallest number of stocks. So my stat here is the Magnificent Seven make up 36% of the S&P market cap. You add the 3 more companies, you get 40%, right? So 10 stocks are 40% of the market cap. Okay, so with everybody totally crowded into this extremely narrow trade, what happens when these stocks falter?
Well,
I mean, does it literally take the world down with them?
no, again, this is, this is the phenomenon that's going on. And again, I don't know how this plays out ultimately, but, we talked about sentiment earlier. And this is the sentiment train that we've built over the last several years, and it's magnified itself since really 2020. But think about 2022, for example. The market was down 20%-ish by the end of the year. We were down like 25% at one point. But the big mega cap companies never really sold off that much. Now, underneath the surface, Kathy Wood got decimated with, her companies like Roku and others that were down 80, 90%. But on the surface, those big cap companies never really took a hit. And the reason is that people were still just dollar cost averaging into their S&P 500 index and their 401k plans or pension plans, et cetera, which was just funneling money to those big mega cap stocks. Well, a lot of those other stocks like Roku and others, they're not in a lot of these indexes. So, or if they are, they're a very small weight, so they don't receive a lot of that funding flow. So outside forces of selling can impact those dramatically. So the answer to what you're asking is really this. What does it take to get the average mom and pop to dump their S&P 500 index, right? Because we've trained over the last 15 years, we've trained investors on 2 things. One, that you get a 15% average return every year. And B, you just buy the dip. Every time the market goes down, the Fed's going to step in, you're going to get 0 interest rates, you're going to get QE, market's going to go up. And this is what we saw in 2022. During that entire decline, I didn't get people panic emailing me going, get me out of the market. They were like, is it time to buy more?
Right, right.
I don't want to miss the bottom. When do I buy? And we had a FOMO of missing out on the bottom of the market, not just the FOMO of getting in. So it's
we didn't see the capitulation, and we've talked about that. Yeah. And to your question, maybe it was rhetorical, but I can only think of 2 things. Right? It's a big enough job losses that the passive bid stops growing, maybe goes negative, right? So you have less amount of money from corporate retirement accounts out there buying in the market, right? So that's number one. The second one is just the invisible dog whistle, right? The tulip bubble, the South Sea bubble, whatever. There is some level out there where it just collapses under its own weight. Valuations just get too big, right? We probably can't have 1,000 forward PEs, on these companies.
Don't say
never. Pardon me?
Don't say never. I never thought we'd see companies sporting 40 times price to sales, but we've seen it. So
right. But theoretically, there is. I mean, as every asset bubble in the past has shown us, there is some magical point at just which you run out of net buyer, the marginal net buyers, right?
And there's normally, and with that will be some catalyst. It'll be some event that occurs that changes that. And again, this all goes back to sentiment, right? Some catalyst will occur, whether it's the next Enron or whether it's the next WorldCom or whether it's the next, Lehman. There'll be some event out there that changes the sentiment. And this is really my big concern, over the next, 5 to 10 years, is and again, if you live through the dot-com crash, it's very reminiscent to what we're seeing now, which was back in the 1995-ish. It was all about the internet. The internet's going to change the world. It's a dot-com thing. And, we made all these assumptions about what .com and what the internet was going to do for things, and all that turned out to be true. The internet was not just a fad; it stuck, and all the things that we thought the internet would do in terms of bringing knowledge and everything to people have absolutely occurred. What changed the sentiment in 1999 was all the assumptions when Enron was revealed as a fraud, and WorldCom and Lucent Crossing, Global Crossings, all this other stuff, all this fraud showed up in the system, which happens when nobody's really paying attention to the fundamentals. Then all of a sudden, everybody had to recalibrate. Oh, earnings aren't going to be, $150 a share, or at that time it was like $64 a share. They're going to be something closer to $8. And so there was this big repricing of market and earnings in the markets, and that's what caused that. But you needed that event, right? You had to have something that brought the attention
Right.
to what was going on. We see a lot of that today. There's a lot of fallacy in earnings expectations. And there's a lot of fallacy in the expected growth rate of a lot of things that are going on. There's a lot of fallacy behind a lot of the themes of the markets, right? Whether it's meme stocks or a variety of other assets. So something will happen, and all of a sudden, when it reveals the fallacy to those thematic views, then all of a sudden you get this big repricing, and that typically tends to occur fairly aggressively, at least historically.
Okay, and I take it you are not going to start materially like taking really defensive measures until you see indicators like rising credit spreads, right?
Yeah, because these things can last a lot longer than you think. I mean, I would have, honestly, we should have saw a much deeper correction in 2022. Earnings should have come down a lot more, but immediately, we hit the market with the Inflation Reduction Act, the CHIPS Act, and we just,
we drained the reverse repo. I mean, all the intervention that the central planners have been doing, yeah.
And while the Fed may be talking about, we may pause on cutting rates, as soon as the proverbial, stuff hits the fan, they're going to be cutting rates and doing, reversing QT and going right back to their playbook. Because again, at the end of the day, everything else set aside, the economy is driven by the consumer. Consumer consumption makes up 70% of the economy. So if you start having a big stock market correction or some type of event, if interest rates impact the banks to any degree whatsoever, the Fed's going to reverse course because they have to protect that confidence within the consumer. Because if they don't, they already realized that from 2008, that if you let consumer confidence go too far in the wrong direction, that's very hard to reverse that. And they're more protective about that mental mindset now than they have been previously.
Yeah, which again is why sentiment is so important, because at the end of the day, that's really what they're trying to preserve. Absolutely. Okay. I'll note that you have a couple of good articles that folks should go read on realinvestmentadvice.com. I just made your plug for you there, Lance. You've got Curb Your Enthusiasm, which we've talked, I think, a lot about the reasons why you're starting to curb your enthusiasm. You also have your investor resolutions for 2025. We don't have a lot of time to go through those specifically today. If you want to, we can go through it next week. But is there one or two resolutions that you just want to flag for folks that you're going to take into this year?
No, the real point of the article is like I list my resolutions and I revisit these every year. And I'd certainly, again, you can, we post all these on our Substack as well. Just look up Lance Roberts on Substack. If you get them all in one place type thing, or our website, realinvestmentadvice.com, either one. But the big thing about the investor resolutions is that, your resolution, I did a whole segment on our YouTube channel this past week talking about the importance of having an investment policy statement. And if you don't have one, if you don't know how to write an investment policy statement, you don't know how to create, if you can't even come up with kind of the basis of an investment policy statement, you probably should not be managing your own money. It's kind of like trying to drive a car without ever having been in a car before, right? Just bad things are going to happen.
Can you just give an example of an investment policy statement?
Sure. Yeah. I have one that I have printed out, sits on my desk at my office, and I have a whole sheet of investment rules that sits on my desk. So a good example is that, our investment policy statement starts with a basic fundamental premise, and it says, okay, we're going to buy stocks that meet these fundamental criteria. If they don't meet these fundamental criteria, they get excluded from our scan. So this helps eliminate a lot of high risk companies fundamentally. Then we have a complete technical overlay on top of that. It says, okay, first technical rule it has to pass is this, then it has to pass this technical rule, and then it has to pass this technical rule. If it passes the fundamental and the technical, we can buy the stock. Now, once we own it, here's the rules for holding it, and here's the rules for selling it. And so there is a written, precise procedure of how to build a portfolio, how to allocate it, what weights, what's our maximum weighting, what's our maximum underweighting, all those type of things. And so we stay within those parameters. And again, as long as we stay within those parameters, it keeps us out of trouble. Mm-hmm. What happens with most investors is they just start buying, oh, I bought this stock today. Well, why did you buy it? And I always ask people this. It's like, oh, I'm long ABC. Well, why are you long? Well, this guy on television told me to buy it. Right.
You get caught up in the story. Yeah.
I heard a guy on YouTube tell me all about this stock, so I bought it. They have no idea why they own it, right? Or they bought it and it's going up, so they're happy with it. The problem with that is you don't know when to get out of it. And this is what happened to a tremendous amount of people in 2022 is they were buying the meme stocks and Bitcoin and everything else because it was going up, which is fine. There's nothing wrong with that. But when it started correcting, they just wrote it all the way back down because they didn't have any rules or guidelines to say, okay, it's coming down. I need to protect my gains. And tons of stories about people having to go back to work because they lost all their money. And, you shouldn't have that happen to you. But again, if you can't sit down and articulate, and again, not mentally, right? If you cannot simply write it down on paper, my first rule is this, my second rule is this, my third rule is this, go hire a financial advisor because you're going to get yourself in trouble over time. It's easy to buy stuff when stuff's going up. It's really hard to maintain your capital when prices are going down.
Yeah, no, totally agree. If you can't write your own operating manual for your investing strategy, then you're flying blind. So yeah. Go leverage your professionals. Yeah. Write your own or go leverage your professionals. All right. So I want to get to the rant, but a couple of things first. Let's pull up the S&P if you can, Lance, and just look at the latest technicals. And while you're doing that, I'll preload the question that I'm surprised. You're probably surprised I didn't ask you earlier when we were talking about bond yields and stuff like that. But after we go through what the S&P is doing, if you can just give whatever update you Sure. want to give on your thinking on your current bond trade.
Sure. Well, again, we'll get to that in a second because we don't trade bonds.
Your current bond position.
Yeah, we'll talk about that. So this is the S&P. And so two things happened over the last couple of days, which are not great for the market near term. So we had a rising trend line that was running from really kind of this sell off here, this 8.5% decline back in August. This was the yen carry trade blow up. And the market's recovered nicely from that. We got to new all-time highs. We've been deteriorating now really ever since mid-December. And we got through, so good news, bad news. Bad news is Santa Claus rally didn't show up. Good news is first 5 days of January turned out positive, but just barely. We were up like 0.2%. But so goes the first 5 days in theory, so goes the month of January. If January goes well, that's the January barometer, means the whole year tends to do better. So first 5 days are okay. We're still within the first month of the year, so the market needs to get a recovery going on pretty quick here. But again, we broke this trend line, which is not great. And we're at the bottom of this kind of declining trend channel that we've been building. So again, we've kind of have this, these declining set of tops that's running right along the 20-day moving average. Another kind of negative that's coming up for the markets near term is the 20 days about to cross below the 50 days. Now, that's not the end of the world. We, for example, back in August, when we had the yen carry trade blow up, the 20-day crossed below the 50 and the market went running right up. And then eventually the market, the 20-day crossed back above the 50. So, that's not the be all end all, but it does apply pressure to rising prices. So again, that's going to be a concentrated level of resistance between the 20 and the 50-day moving average that the market's going to have to get above when it tries to rally. And so if the market can rally from here, we're going to, there's a real potential that we're going to kind of run up to this, right, the bottom of this rising trend line, which is going to coincide with the 50 and the 20-day, all kind of clustering at that one spot.
Yeah.
And that sets up potential for a market failure there to come back down and kind of retest this 100-day moving average. Now, as long as we stay above the 100-day, we're okay. If we start getting below the 100-day much, that's going to be a little bit more problematic. Now, one thing to say about all this is the market on a momentum basis is getting decently oversold here. We're in the territory now to get a reflexive rally. We've had kind of a long stretch here of sloppy downward trading. And we've seen this kind of action before. We've got negative money flows. That'll eventually reverse, but we need a little bit of good news in here to potentially spark that. So let's say next week we get kind of a weaker CPI, PPI reading. That could certainly give the markets a boost here, and that oversold condition, that negative kind of sentiment we're going on right now, that allows a lot of money to flow back in. So we reverse those negative money flows and we get a spate of kind of runs to the upside here. We're looking for that to reduce risk into. So, we're kind of expecting a rally here by the end of the month. And if we get that rally into the end of the month, we're going to be looking to kind of rebalance risk a bit, shuffle some things around, kind of try to lower volatility in the portfolio overall.
Okay. Would that include increasing your percent cash in the portfolio at that point in time? Or, yeah?
Potentially, we're right now, we're target weighted. We're about 61% equities. Our target weight's 60, so we're real close. We're underweight bonds and target weight equities. So, we might pull that back. And again, we'll probably do some adjustments in the portfolio initially and kind of maintain 60%. So maybe we'll trim off some, Amazon or Apple, and we'll buy a little bit of some kind of our value stocks that we have in the portfolio. But if the market continues to deteriorate, then we'll start just raising cash levels. Okay. So we don't want to try to anticipate too much we don't want to get overly defensive too soon because that impairs performance. But we want to be very mindful about raising cash levels as we need to.
Okay.
Yeah.
All right. Well, we'll obviously be tracking that every week going forward here with Lance. Okay. So
let's talk about bonds, though.
Bonds. Yeah. And let me just toss out something for you to react to. Given what I know of your and your partner, Michael Leibowitz's outlook on bonds, and you've reiterated several times in this discussion that you believe, treasury yields should be lower. As these yields continue to rise, are you, I don't get the sense that you're necessarily sweating. I'm thinking maybe you're thinking about buying.
Actually, it's so a couple of things. So we have a couple of considerations and it's a great question. We have a couple of considerations that we're currently talking about. So one, so again, as I said earlier, the last time that yields were here, inflation was dramatically higher. But and here, let me just share a different chart with you. Are you still, no, you're not still seeing my screen.
No, we're just seeing your face.
That's a terrible thing. You should just have my screen up all the time. So this is a long-term chart. So you got to be careful with monthly charts because monthly charts are very, very slow to move. But the last time that we were here in terms of yields on a technical basis, that's where we actually started buying bonds. And we added to our duration in our bond portfolio. And we talked about it here on the show, we took some of our very short-term bond money, their short duration, and we lengthened that a little bit. We went from like 3 to 5 year maturities to 5 to 7. Not dramatic moves, just little moves, and we increased duration. We're now approaching that same point again with inflation a whole lot lower. So from a technical basis, the look to buy bonds is becoming a lot more attractive. However, doesn't mean we're going to do it right now. We're probably not going to touch our longer duration bond side. So we have one position in our portfolio that makes up about, so again, bond construction 101. I don't own bonds for a trade. So I want to correct that statement because I get that a lot by email. We don't trade bonds. That's not what we do. We manage balanced portfolios of various types. We have 60-40, 80-20, 70-30. We have 100% equity. We've got 100% bond portfolios. So it depends on what our clients' needs are. So if I own a 60-40 model, I own bonds in that portfolio because it limits volatility and it provides an income stream. We talked about generating returns previously, where if my goal is to generate a 6% annualized rate of return, and I'm getting and just pick round numbers, 5% from, say 50% of my portfolio is bonds, I've already got 2.5% of my 6% locked up. So I don't have to do a lot of work on the equity side. Mm-hmm. So it's important to remember why you own bonds. I own bonds for asset protection because they mature. I get a consistent income stream. And one of the big problems that investors have owning bonds is that the income is not reflected on their position on their statement. So I get a lot of emails from people like, I bought TLT and it's down, 5% or whatever since I bought it. Okay, it's down in price. But add in all the income you got from it last year. So you owned it for a year, it's down 5%, but you got 4% in yield. So you're really only down 1%. But see, we don't look at it that way. We're just so focused on the red, right? Just on that position, because nobody reports the income you're receiving from the bonds. And so you have to look at this from a total return basis. But we don't do that as investors, so we make emotionally bad decisions. But back to your point real quick, and so we have to own bonds. So in our 40% bond portfolio, we only own about 10% of that 40% is actually long duration bonds. The rest of it is all very short-term bills and a little bit of kind of moving towards intermediate duration. So there's two factors we've got going on here. I'm getting to the point to where I really want to buy more long duration bonds. I think we're getting close to that point, but it might be a couple more months. I want to get through this inflation report next week, see what it looks like. But all indications are suggesting that we're going to have slower rates of economic growth this year. So it might be a few more months before I add to long bonds. But in the short term, we have to manage our client psychology as well. So one thing that we're talking about doing, now we're not doing this right now, but one thing that we're talking about doing is shifting back duration just a little bit. So in other words, we take some of our 5 to 7 and we move that to 3 to 5 year maturities. We take some of our 3 to 5 year maturities, move those to 1 to 3, and we just shorten duration a little bit, which will reduce the volatility in the bond portfolio temporarily. So if sentiment continues to push interest rates higher here, hedge funds, et cetera, all this kind of sentiment driven trading does push rates higher, it tampers that bond portfolio portion just a bit. So we might, and again, I'm not saying we're definitely going to do this, but we might moderate some of the duration near term. But again, I kind of got to get some more data here over the next week or so. But if I'm a long duration bond owner and I'm buying into, if I'm buying treasuries right now, I'm going to hold the treasury for the next 5 years, in time frame, they're very enticing at this level.
Okay. All right.
Well, again, I'm going to get 5%. So again, remember a couple of years ago, you were talking about T-bill and chill.
Yeah.
And everybody was piling into T-bills. And I said, that's probably going to be a terrible idea. And it was, because you missed 20% return years in the market by doing T-bill and chill. But everybody was okay with it because, hey, I'm getting 5%. Well, now the Fed's cutting rates. So now you can't buy T-bills anymore because you don't get 5% anymore. But now you get 5% in a 10-year treasury. And again, that's what we were talking about earlier on a valuation equity risk premium basis. That's becoming very attractive.
All right. Okay. Well, look, we will. This is not the last you're going to hear of this, folks. We'll let Lance keep us abreast of all this as the data, more data comes in, and if and when RAI make some of those portfolio allocations, you'll let us know on this channel.
Yep.
Yeah. All right. Well, look, in starting to wrap up here. Trades, Lance, have you guys made many trades over the past week?
No, not in the last week. There's not been a lot to do. Again, we're kind of evaluating the whole portfolio right now because it's a new year. So First thing we do at the beginning, and this is something investors should do in general, is that within the first couple of weeks of the year, evaluate your portfolio. And what the mistake that investors always make is they look at last year's performance and they go, well, my performance last year was X, the market was Y, and they compare themselves against some benchmark that has nothing actually to do with them in terms of their time duration or risk tolerance or everything. So we say, here's my portfolio, here's the market, and who cares, right? But that's how we do it. So we look in hindsight, and then we start going, well, last year mega cap did well, so I'm gonna go pile everything I own now into mega cap stocks because that's what worked last year, so that's gonna work this year. That's really a really backwards way to look at it because generally what worked last year doesn't work this year. And I think this is gonna be one of those years where a lot of the big boomer trades last year don't work because of a shift in sentiment, whatever occurs. Again, doesn't mean tomorrow, doesn't mean the markets are going to crash, but we'll see what happens. But the areas that I'm really concerned about over the next 12 months, I don't think small cap, mid cap makes a huge comeback for earnings reasons. I do think large cap runs into some challenges because of valuations and because of rising interest rates. And if interest rates do start to impact banking systems in terms of collateral values, et cetera, I think the Fed's going to get caught flat-footed, and then we're going to have a whole nother issue to deal with. So, there's just as we're kind of looking forward, we're really kind of looking for, kind of rebalancing that portfolio towards lower volatility, a little bit of less risk, and trying to increase income yield, I think.
Okay. Yeah, it definitely sounds like, at least on equity-wise, you're trying to dance a little bit closer to the door. You're not leaving the dance floor yet, but yeah.
Well, it's like being in a theater, right? Somebody yells fire, you want to be closer to the door, the exit than not. So,
Right, right.
I don't think anybody's yelling fire just yet, but I definitely. And again, when I'm talking about risk this year, I'm just talking about the potential that we could see a 5 or a 10% decline, much more likely than a 5 to 10% advance.
Okay. All right, got it. And that's, folks, again, that's the position of the eagle. Lance isn't trying to, be a bear. In fact, he's usually the bull on this channel. And I think when the bull is starting to say, hey, look, I'm getting a little nervous, it's worth us just paying attention to. All right. So let's switch from bulls, bears, and eagles to wolves here for the rant.
Sure.
So you probably heard of this old story, and it's been attributed to Native American folklore. Although I think on the internet I've learned that this might just be apocryphal. Somebody just might have made it up, but it's still an instructive story, and it's the story of they say inside each of us there are two wolves.
Mhm.
Right. One is driven by fear and anger. It's sort of the destroyer, right? It's the killer wolf out there that does a lot of destruction. The other one is full of hope and positive energy. It's the strong, lone wolf provider, right? And the question is, which one of those wolves is going to win out in you? Right. And the answer is well, whichever one you choose to feed more. Right.
Yeah.
And I've been thinking about this because this year, knock on wood, I think I've done a better job than most years past where, reflecting on how I want 2025 to go for me and my family. I have, I think, been leaning in much more successfully than I have in a number of past years of just the things that really excite me that I have control over, and basically saying what's the good I want to see in the world, and how do I just focus on that, right? And I contrast this with I think it's totally human nature to just get frustrated, about the things that bug us, and dwell on how do I either get rid of the things that are limiting and frustrating me, or maybe even more so, and to our worst human natures, like how do I get revenge on these people that have done me wrong, or these issues that really bother me, right?
Right.
And there have been I've we all have transition in life. Had a lot of things that have happened in my life in the past couple of years that viewers, frequent viewers are familiar with. My parents both passed away in 2023. Had a big professional change where I left a business I'd been at before. and went fully independent on my own. And there were elements of that transition where things didn't go exactly the way, behind the scenes I would love for them to do. And it's easy to kind of get wrapped around the things that you're unhappy about, right? And I think an important part of my positive, evolution this year has been really just developing the mental fortitude to just say, I'm just not going to worry about it. I'm just not even going to think about it, right? And instead, I'm going to take my mental energy and I'm going to focus on the good that I want to see manifest in my life. And this whole, two wolves analogy, it's true. You get more of what you focus on. And so if you dwell on the negative, if you dwell on the frustration, if you dwell on the sense of injustice and I've been done wrong and whatnot, highly likely you're going to get more of that because that's where you're placing all your energies. And I think it's a hard thing for us people to be able to develop the emotional armor or shielding to just say, I'm just not going to let it bother me because we are so wired for justice and injustice. We've talked about the experience with the capuchin monkeys and things like that, right? I mean, we have a strong sense of injustice, but it's true what they say, the best revenge, if you will, is a life well lived, right? Which is okay. Just don't let turkeys get you down. Don't let the folks, that are making your life less enjoyable, don't let them win. Just literally just let it all go and spend your energy on making the things that you want to have going forward. And really, once you get to the point where you're realizing, I'm not thinking about that stuff anymore, it's so liberating. It's so freeing. It's such a catalyst to your quality of life. And Lance, you've been nodding the whole time, so I'm going to let you chime in here in 1 second. I just want to put up this matrix here, which I've always found useful, this personal power grid. And you'll see here, it's got two vectors. One is the things I can control and the things I can't control. And then versus, okay, well, am I going to choose to take action or am I going to choose to take no action? And a lot of people spend their time in this ceaseless striving frustration quadrant, which is, and I used to do this a lot, when I initially started doing financial media, is I'd get so frustrated at what the Fed was doing and why, or like credit spreads, why are credit spreads not moving, right? I can't control that. Right. So I got to learn to just stop worrying about this, stop spending energy and frustration on that. Because I'm not going to make any progress. I'm just literally going to keep getting angry and frustrated. It's going to distract me from being able to do the good stuff. So obviously you want to spend your time in this mastery or empowerment quadrant, right? Of taking action on the things that you can't control. And very importantly, when things are frustrating you, you make one of two decisions. If you have the ability to take action on it and get rid of the frustration, fantastic, do that. Put that at the top of your priority list. I'm going to take this thing and get it done and get it out of my life. But more importantly, and this is where I think a lot of people just have trouble getting to the point of, is this bottom right quadrant of letting go, of just saying, you know what, it's just not worth it. This is just something that is ruining my quality of life, and I can't even really do anything about it anyways. Let me just let that thing go out in the world. And yeah, if I felt like that guy did me wrong or whatever, fine, whatever. It's in the past. I'm not going to worry about it anymore. I'm going to spend my time in that upper left quadrant of just focusing on the things that can make my life better. So I will take a beat here, Lance, but you've been sort of smiling the whole time through there. So I assume some of this resonates with you and your experiences in life.
Oh no, absolutely. I mean, it's just, I can, write a list of people that if I could have a hit list of people.
And the Lance Roberts enemies list, yeah.
Exactly. Go, Jack Reacher, go take care of this list, right? There'd be a fairly long list, but again, what happens for most people is that an event occurs of whatever it is, and they've been wronged or something didn't work out the right way. And so we take on, to your point, we take on kind of one of two things, one of two behaviors, which is either A, I'm never going to do that again, meaning I'm never going to do anything like that ever again, which, so I was trying to start my business and it failed for some reason. And so I'm just never going to try to start a business again. I'm just going to go back to working, my 9-to-5 job. And that's not the appropriate response. It's like, okay, understand why it failed, and don't repeat the reasons why it failed. Learn from that experience and then move on and do something better. The other thing that we do is that we try to blame somebody else for our problems. Whatever our problem is, we're always looking for somebody else to blame rather than looking internally and saying, why did this happen to me?
Right.
Did I do something that put myself in this position to be here? And so now I need to fix that. And most of 99.9% of the time, at the end of the day, it's not anybody else's fault but yours. And that comes down to everything from, your job. I didn't get a promotion I was wanting. My boss didn't like me. That's why I didn't get a promotion. Well, really, is that the case? If you really look at it, were you doing everything you're supposed to do? Did you show up to work on time? Were you going above and beyond, really producing excellent work? Or was it, that's kind of the point. Or when it comes to investing, right? Oh, it's not my fault my portfolio went down last year. It's, the Fed's fault. It's the debt and the deficit. So those are things we have no control over whatsoever. So the only thing we can control is what happens inside of our portfolio and what happens with our savings. Are we saving enough money? Are we, controlling our cash flow at home? All those things pretty much come back down to our own responsibility. And to your point, we either have that ability to accept and acknowledge that personal issue that we have and realize that we're not a victim, that we're actually empowered to fix those things. We just have to recognize the problem and now fix it and move forward. Or you can spend your whole time just kind of wallowing in self-pity, so to speak, and never go anywhere because it's always somebody else's fault. And look, I can tell you a personal story. My brother, who is 5 years older than I am, he had a terrible experience young in life. And, he got married right out of college. The marriage ended drastic. I mean, just terrible. It was just a horrible match to begin with, but it was just a bad decision. But instead of just coming to the realization that he made a bad choice and that, he wouldn't make that mistake again, he just never had a relationship ever again in his life because he said, I'm never going to put myself in a position of being hurt ever again. And he's been alone for the last 45 years, right? He's now 65. Never been with another person since then. He's just been solely living alone. But see, that's a choice he made. He's miserable personally because he's got no relationships. And great article out this past week, by the way, great study out talking about the most important thing for longevity is your social relationships. And we've talked about that before.
Yep.
But, he's got no personal relationships, no connections, no nothing because he was too afraid of being hurt ever again, right? And so that's the victim attitude. It wasn't his fault this marriage ended badly. It was her fault. It was the world's fault. It was this fault. It was everybody else. And he's the victim. And once you claim that victim status, it is very difficult to get out of that mentally. So if you've got that mental position that you're the victim, change that mental status from I'm the victim to I'm the conqueror and start going out and taking advantage of the abilities you have and start building on that and be aware things are going to go wrong. And when something goes wrong, understand why it went wrong, understand why it's your fault they went wrong, fix it, and then keep moving forward.
Yeah, and so very well said. I feel for your brother and certainly know people like that. And that's why I kind of like this, adage or analogy of the two wolves. It just keeps it real simple,
Yeah.
Which one are you going to feed, right? Because, if you, like I said, whatever you focus on, you get more of, right? So do you want more hope and optimism and better things? Great. Well, then feed that wolf, right? If you find yourself, you're feeding the angry, fearful, negative one, it's a festering process, right? It builds, it snowballs. You're just going to get more and more of that in your life. And do you want to be somebody who years down the road just has a lot more of negativity in their life? Most people, I think, would normally say, no, I don't. But you got to break out of that mentality, like you said, conqueror versus victim, or just which wolf. When I wake up today, which wolf am I going to consciously try to feed here, right?
And I can't tell you real quick, just finish this up, is that, you've got to find another person in your life that you admire and respect, that you can talk to, and again, we talked about the importance of having a mentor.
Yep.
But when you start looking around yourself and look at the people you surround yourself with, if everybody you surround yourself with is also a victim, that's part of the problem because, you know, and this is why old people typically wind up with fewer friends is because we figure out we got to get rid of a lot of negativity in our life.
Mhm.
But, you know, you don't need a lot of friends. I tell my kids this all the time, right? They've got these huge friends groups. There's like 50 kids in this friend group. It's like, oh, it's our friend group. We're best friends forever. I was like, no, you're not. In 10 years, you're not going to know any of these people.
Right. Yeah.
But, you know, you surround yourself with one or two really good people that are you know, focused. They have a good, strong moral compass. They're optimistic about the future and that they can help move you forward. If you can surround yourself with just one or two of those people that you can work with and talk to and relate with, you'll be amazed at how fast you'll start to grow, both financially, success, work-wise, et cetera. And that, you know, if you work in a company, find yourself somebody in that company that is that way, and you'll be surprised at how fast you progress.
Yeah, well, I mean, it all comes back to our big three, right? You know, what really matters in life are quality relationship, not quantity, but quality relationships, purpose, and health, right? And you know, rather than repeating a bunch of the stuff we've talked about a lot, folks, if you want more information about how to build quality relationships, feel free to go watch the video Thoughtful Money did on that. Full disclosure, it was my wife who was a couple therapist, but that's at thoughtfulmoney.com/relationships. Um, one thing I'll mention too, just based on what you said, Lance, is you know, what oftentimes happens, especially in relationships, which can be really self-sabotaging, is, yeah, I mentioned we're sort of wired for justice or injustice, right? We'll get wrapped around the fact that you know, especially if we have the victim mentality that I'm in the right and everybody else is in the wrong, or this person's in the wrong and I'm wronged here, right? And you know, the celebrity therapist, right? Dr. Phil, he has this expression that I actually think is a really good one, where, you know, someone will be bitching to him about how, you know, they've been wronged, and they're like, and on this point, I'm so right. My wife just doesn't get it and she won't concede. And he's like, okay, so you're right. All right. How's that working out for you?
Mhm.
Right. And it's like this issue that you're claiming moral victory on is the thing that is, you know, ruining your relationship. It's the thing that you and your partner just can't see eye to eye, and it's creating so much stress. And it's like, at some point, do you want to just give up the being right part and pick up the, like, I want to have a functioning relationship with this person, right?
Yep.
But so many times we just want to wrap this cloak of being aggrieved on us and just say, look, it's the world's fault, right? And last point I'll make on this too is a quote I've given many times, but I find it to be very, very important, which is to your point about, like, if you're stuck in these patterns in life, you got to really take that hard look inwards and say, look, am I just like the most unlucky person in the world? Or do I have some accountability in this, right? Is this thing keep popping up in my life because of something that I'm doing, right? It's a great quote from Carl Jung where he says, until you make the subconscious conscious, it will rule your life and you will call it fate.
Yep.
Right. So you will say, oh, I'm terrible in relationships, or I always lose money in the stock market, or whatever, right? This sense of like, these things are happening to me, where in many cases, it's because of something that you're doing. And until you actually shine a bright light on that and name it, it's just going to be this pattern that you can't break in your life. And you're just going to say, well, I guess the universe just hates me, right? But it's really because of something you're doing. And once you identify that, then you can break the pattern, right? There's a lot of power in that, but
Yeah.
you got to take that agency.
Absolutely. And I don't know about you, Adam, but I learned the secret to a happy marriage a long time ago, which is my wife is always right.
Exactly.
So
I
I
was
just,
going to try to beat you to the punch on that one.
yeah, so
Yeah.
she's always right. I'm always wrong. It doesn't matter. I think what you just stated is the best statement of the entire conversation, which is that when I look back at, you know, things that went wrong in life and I wanted to blame somebody else, at the end of the day, if you just analyze what you could have done differently, that outcome would have come out differently. And as I said, you know, it's like you can wear that cloak of being right, but that doesn't matter. If you being right is keeping you from succeeding, then it doesn't matter, right? So just we have to start to learn to adapt and understand that sometimes just the victory of being right is not the solution to the answer.
Exactly. Yeah, the victory to being right is not worth the cost of potentially losing the war, right?
Yeah.
So all right, so folks, hopefully you take from this personal accountability, but more importantly, when you wake up in the morning, just ask yourself consciously, which wolf am I going to feed today? No matter what happened in the past, sunk cost fallacy, it's in the past. What can I just do to focus on the things that are going to make my life better from here? All right, Lance, always a great discussion, my friend. Folks, if you think one of the best ways you can feed the right wolf in your life is to watch Lance Roberts on this channel week after week, let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And very importantly, if you'd like some help preparing for what looks like it's going to be a rockier 2025, especially if you don't have your own, portfolio strategy playbook. I can't remember what you called it, Lance, a portfolio positioning strategy.
Policy, investment policy statement.
Okay, if you can articulate very clearly your own investment policy statement, highly recommend that you then do work under the guidance of a good professional financial advisor to prepare for the year ahead. If you've got a good one, great. But if you don't, and would like some help, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses for that purpose. Perhaps even Lance and his team there at Real Investment Advice. To do that, just go to thoughtfulmoney.com, fill out the short form there. The firms will be out to you very quickly after you do that. Lance, my friend, great week as always. Really looking forward to seeing you in Houston next week. Anything you want to say in parting about the upcoming event?
Yeah, we are almost sold out of tickets. So if you haven't gotten your ticket yet, we do have a block of hotel rooms set aside at a discounted rate. So if you want to fly in, drive in, however you want to get here to Houston, love to have you here. We're going to we've set the conference up this year so that Mike and I will do complete presentations on markets, bonds, interest rates, inflation, debt, stuff that you name it. We're going to have a live thoughtful money, so to speak, with Adam discussing topics all over the board, whatever your questions are. But then we've also set aside about another hour and a half just to visit with you personally. So you can come up to Adam, myself, Mike, whatever, ask any question you want to ask. And we're going to spend time with you personally to answer those questions. If you want to come in, this will not be recorded. It will not be distributed. It's a live and personally only event. So after the fact, there won't be any recording of this. So the only way to get there is to come to Houston. We'd love to have you, love to visit with you. But the tickets are on our website, realinvestmentadvice.com. There's a banner at the top. Just click that link. Tickets are $149. And again, we only have like 10, 15 seats left. So love to have you. If you want to come, get by the website today and get signed up.
All right. Well, head on there, folks, if you haven't yet and want to come. Lance, I'm really looking forward to it. And and I'm very much looking forward to seeing this audience that's able to make it there in person. As I've said, we've talked about this in the past. Super fun for me, but super valuable for me to hear from people, what they want to see more of going forward.
Yep.
All right. Well, it's going to be super exciting. Look forward to seeing you there, Lance. Everybody else, thanks so much for watching.